Hi everyone, welcome to my channel. If you like what you see, please give this video a thumbs up and remember to subscribe. Today we're going to talk about how to get started in investing in Canada through a TFSA, RRSP, or a non-registered account. So before we start, I just want to put in this disclaimer saying that I'm not a certified financial planner and that everything that I'm saying in this video is just my own interpretation on what I have read up on, so you shouldn't take this as a source of truth. I encourage that if you find anything in this video useful, that you do your own research on the topics. So the overview for today is that we're going to talk about how to start an investment account, what accounts are there to open, and then I'll end off with a word of caution if you're starting to invest. So now let's talk about how to start an investment account. In Canada, any of the largest 6 banks can help you with that. You can select the one that you already bank with. That will help opening an account and transferring funds easier. What I find is that traditional banks usually charge a higher trading fee than non-traditional banks. The transaction fees for larger banks are within $10, depending on how many trades you make. In general, if you don't plan to make a lot of trades, these transaction fees won't really affect you that much, but if you're planning to trade in and out very often, then $10 each time you sell and each time you buy can add up. There are free options out there like Wealthsimple, and it really depends on what your preferences are. Sometimes I see that if you pay more fees, you might get better tools to use, but if you're just an investor that wants to buy a stock and just leave it there, then maybe Wealthsimple is the way to go because it's free. If withdrawing money is a concern for you, I could tell you that I've used both Questrade and Wealthsimple and they both seem to work fine for me. Now that you know where to go to start your account, let's talk about what accounts are there for you to open. So now let's talk about the tax-free savings account, otherwise called the TFSA. So who can open an account? It's essentially anyone who is 18 years old or older, has a valid SIN number, and is a resident of Canada. Note that if you're a non-resident, you'll be subject to a 1% monthly tax on the contributions that you've made. So now let's talk about how much you can put in every year. If you were 18 years old in 2009, or in other words, you're 31 years old in 2022, and you haven't ever contributed to your TFSA, you can put in $81,500. For everyone else, it's about $5,500 every single year that you can put in since you've turned 18. On the right-hand side, you could see a chart that shows you every year and what is the maximum limit you can contribute to your TFSA, and then what is the cumulative total that you can contribute. Every year, the government will release what is the maximum limit you can put in. Don't worry if you don't really keep track of how much you've contributed, because if you log into your CRA website, you could see how much you're allowed to contribute as of January 1st of that year. All the money that you take out of your TFSA in one year can be recontributed in the following year. And I'll show you an example of what that means on the next slide. Something to note is that if you have overcontributed, you would be penalized to a 1% tax for the excess amount that you have contributed, which is not worth it. So for example, on December 31st, 2021, you had an original balance of $11,323 in your TFSA, and then you withdrew $6,323, you will have a remaining balance of $5,000. As of that date, you have a contribution room of $0. As of January 1st, 2022, you would have a starting balance of $5,000, which is how much you ended off the year with, and then your contribution room for that year is the $6,000 limit that you were granted from the government, and then any withdrawals that you've made the previous years, which is $6,323, which makes your final contribution room $12,323. So now let's talk about what the TFSA can hold. It can hold stocks and mutual funds, guaranteed investment certificates, cash, and bonds. A note here is that if you're thinking to buy and sell every single day on this account, you might want to watch out because the CRA may deem this account as a non-registered account because the purpose of this account is for long-term investments. So now let's talk about how does the tax work. There's no tax deduction when you put in the money, unlike an RRSP, which we'll talk about in the next slide. All Canadian and US investments are tax-free when you take it out, but then there is an exception for US dividends, where you do have to pay a 15% withholding tax, and that would automatically be deducted every time they pay you dividends. In terms of tips, this account is used for long-term investments. It's a great emergency fund because you can withdraw and put back the money that you put in. And if you have any money in a savings account and you haven't used your TFSA, you should consider putting the money in your TFSA, as all interest income is taxed at 100%, whereas if you put it in here, all the interest that you gain is tax-free. So now let's talk about the Registered Retired Savings Plan, which is also called the RRSP. So you can open this account if you are 71 years old and under, and you are a Canadian resident for tax purposes. What is the amount that you can put in every year? It's 18% of your prior year's earned income or annual limit. So whichever one is lower is your limit. The CRA defines earned income as employment earnings, self-employment earnings, and certain other types of income, then subtract specific employment expenses and business or rental losses. If you're not sure what this all means, essentially for most people it's just going to be how much you earn from your T4. And if you're still not sure how much you can contribute, you can log into your CRA profile and that will also tell you how much you're allowed to contribute that year. I'll put in a link in the description below on where to go to log into your CRA profile. What you can hold in this account is essentially the same as what you can hold in a TFSA. So now let's talk about how the taxes work for your RRSP. So it's whatever you have put in, so that's called your contributions, are deducted from your income. So essentially, if you made, let's say, $70,000 in a year and you put in $20,000 in your RRSP, your tax amount is essentially as if you made only $50,000 in the year. Whatever you take out of your RRSP, that's just deemed regular income, regardless of how it was generated. So for example, if you had money in your RRSP and you bought some stocks and it had great gains and you made 5,000% return, whenever you take out that money, it's not deemed as capital gain anymore, it's just deemed as normal income. So the tax implications would be the same as if your salary suddenly went up that year. The biggest advantage of the RRSP is the tax deferral, which means as long as you don't withdraw money out of the RRSP, you don't need to pay taxes until the time that you do. So all your investments within your RRSP, you can continue to buy and sell different investments and you won't be taxed until you finally withdraw that money out as cash. So sometimes people ask, can I withdraw the money from my RRSP tax-free? The answer is no, but you can borrow the money. What the RRSP allows you to do is that there's two special programs. The first is the Home Buyers Plan for first-time home buyers, and the second is the Lifelong Learner Plan. Both of these plans allow you to withdraw money out of your RRSP, but it's really considered a loan to yourself, which means you have to actually pay it back eventually. So depending on the plan that you borrowed from, if it's the Home Buyers Plan, you have to pay it back equally in 25 years. If it's Lifelong Learner Plan, you'll have to pay it back equally in 10 years. So the benefit of this plan is that you get access to cash that you normally don't have access to, and you can borrow from it interest-free. So if you're someone that's looking to buy a home in the near future and it's your first home that's under your name, or if you're planning to go back to school to post-secondary and complete a part-time or full-time education, I take some more time to read up about them as there's more specific requirements you need to meet. Something to note is that if you took money out of your RRSP for these two reasons and you didn't pay it back for whatever reason, the amount that you have not paid back will just be added to your income. So now let's talk about some tips on the RRSP. Normally people will use this when they're in retirement because they're in a lower tax bracket, but that doesn't always have to be the case. You can also take out the money whenever you're in a lower tax bracket and you need the money as well. The second tip is that you can contribute to your RRSP and start getting the tax deferral on the money you invested, but not take the deduction on your income until you are in a higher tax bracket. The reason for this is because deductions on your income in a higher tax bracket will reduce your taxes payable more. Normally, people will do this if they're in the lower tax bracket now and that they know that they will be in a higher tax bracket within 5 years. The third benefit is that if you want to buy any US stocks that pays any dividends, unlike the TFSA, there is no withholding tax. So this would be the preferred method of buying US stocks that pay dividends. The last tip is that any contribution that you make between January and March of the next year, it can be considered last year's contributions if you want. Now let's talk about the non-registered account. So who can open one of these accounts is essentially anyone over the age of 18. What is the amount that you can put in every year? There's actually no limit, so you could put as much as your heart desires. What can you hold in this is essentially the same as a TFSA or RRSP. So you can put stocks, bonds, GIC, savings deposits, mutual funds. So how does the tax work on this? Essentially everything is taxable. So if you buy shares, it'll be capital gain. If you have any interest or dividends, you'll get taxed whenever you earn them. So some tips on the non-registered account is that you should use this after you have maxed out your TFSA and you no longer want to contribute to your RRSP, as those two will either give you tax-free investments or tax deferral. If you are thinking of keeping any investments in your non-registered account, I'd recommend putting stocks as they would be taxed the most favorably. If you have any capital losses, you can carry forward them indefinitely, or you can carry them back for 3 years and recoup any capital gains taxes that you've previously paid. To end off, I just want to give you guys a word of caution. If you're going to start investing, you want to know what your risk tolerance level is before you start investing, and there are ways to reduce the risk that you're going to be taking on your investments. If you want me to go into detail about those, leave me a comment below and maybe I'll do a future video on it. Thanks again for watching my video. If you like what you saw, please give this video a thumbs up and remember to subscribe. If you have any questions or comments, please let me know below.